Welcome, everybody, to the Financial MD show. We are here, your host, once again, John Solitro and Dr. Trevor Smith. How are you, Doc?
I'm good. How are you?
I'm great. I'm, as you know, sunglass shopping. We're trying these out. We'll see. I've
That's
gotten
right.
some other good recommendations. Thank you, sir. So,
You're welcome. You're welcome. American Optical.
American Optics. Sponsoring today's episode is American Optics. They don't pay us at all, but we're going to pay
Yeah,
them,
I think
apparently.
is it American? It might even be American Optical. Either way, it's the Top Gun. It's the famous Top Gun aviator, but they make some other less enormous
Well, I got
frames.
to tell you, coming from an ophthalmologist, that has to mean something. So,
Yeah, they're great. Super quality.
all right. Cool. Well, we wanted to just bring in a short episode today. We're going to try to get this out as soon as possible and talk about, it's now February 28th, the last official day of 2 of 22. Hope you all did wonderful things on 2/22/22. That was pretty exciting. And, but a lot's happened this year. This has probably been one of the worst Januaries on record for a long time. And from the stock market standpoint, here at Financial MD, we had investors who were down 15% within the span of a month or two because we had some aggressive stock portfolios and the stock market just took a hit. And there's a lot of reasons for that. We're going to talk about a few of them today just briefly, but we've also got an uncertain future, frankly, and we're not going to beat around the bush with Russia invading Ukraine. That's a big deal and could be potentially the start of a World War III, or could be this is as far as it gets and things start to back down or anything in between. So, I don't know, Trevor, your thoughts?
Oh man, yeah. I didn't think that was going to happen. Honestly, like
I
I
didn't
I
either.
like to say when I'm wrong, and I thought it was kind of going to be an overblown
Yep.
thing. Maybe it's just my bias from watching the news over the past couple of years now. I feel like everything has been a bit more extreme,
Mm-hmm.
shock value and all that. But
Oh, sure.
man, I was wrong. I mean, my bias, I think, was pretty clear that direction. And I also just kind of thought, man, there's a lot more to gain from not invading another country, and Russia has a lot to offer in the energy department, but
Mm.
apparently they want something that from their perspective is rational, right? Not from my perspective is not.
Yeah.
There you go. It just when that doesn't match up, you end up being wrong. I also think the markets were overheated anyways in terms of the markets.
Well, yeah.
So I think that the psychology of markets, there's that nice like fear and exuberance and euphoria and all that stuff where we just have certain emotions when prices at certain kind of like patterns of if it's up at the
Right.
top, we want to buy, we're biased to buy high and sell low. When stuff starts to happen, we look for reasons. It didn't
Yeah.
necessarily go down because of the Fed. It didn't necessarily go down because of Russia, although with war, I mean, it usually does.
Yep.
But yeah, I mean, it's like the thing that I try to remind myself is that we know the market is going to go down at some point. And so we
Yeah,
can,
we know that, but for some reason, every time our investors, our clients are
yeah,
just
you get calls, right?
still get calls. Yeah, hey man, what's going on? I don't know. The market's doing what it always does.
Yeah. So a volatility, of like when Bitcoin goes down 30% in a week or 20% in a day,
Yeah.
and it has a volatility of 100, you shouldn't think what happened. You should think, oh,
Oh, that took a while. Yeah.
yeah, oh,
It's
it's
about
being
time.
volatile. It's being volatile the way volatile assets are volatile.
Yep.
And the S&P has a degree of volatility. It's just a lot less because averaged over a bunch of things.
Well, it's a lot compared to, honestly, if we look at from a consumer standpoint of average client portfolio is not 100% stock. It's not a S&P 500 index fund. It's stocks mixed with some international, mixed with some bonds, probably mixed with some, just different stuff that's meant to diversify it and reduce the beta or the volatility or the standard deviation. All those terms are fancy advisor terms for volatility or the ability, frequency, or what's the word, intensity that something might go up and down.
Mhm.
And all of these things are compared against the S&P 500 typically, probably the most common benchmark in the world. And every time we put together a portfolio, we say, here's how it compares in volatility to the S&P. And if the S&P is 1, if you guys remember statistics, 1 would be a perfect correlation. 0.6 or 0.5 would be, it's got about half the volatility of the S&P 500, and 0 would mean it's got no volatility. And if we
Mhm.
get a point 0.5 or a point 0.6 beta or volatility type of correlation coefficient, we feel like we're doing really well. And so in those terms, the S&P is very volatile. It's like the volatile thing that we compare against. But when it's really not, like obviously you're looking at cryptos or Bitcoin,
Mhm.
obviously. But we got to keep in mind that 2008, the S&P dropped 40%, give or take, depending on what numbers you look at. And I feel like how quickly people forget. That's not to downplay at all what's going on current event wise, but we're talking about stock market and investing today. And financially, something was going to make the stock market go down. It was just like a house of cards that something just had to flick that little card, right? And not that the house of cards is crumbling, but you know what I mean.
Yeah, I was trying to find there's MicroStrategy, since I'm into the Bitcoin stuff, they have a
Uh-huh.
cool website where it compares the volatility of every major asset. So then you can just look at them like head to head. I'm
Yeah.
not finding it right now. I'll try to find it so we can put it in the show notes.
Yeah, that'd
But
be cool.
it's cool because you end up realizing like, oh, you can just look at every asset. You can
Mm-hmm.
look at every index. You can look at gold, all the classic inflation hedges and stuff, and look at their like risk adjusted volatility.
Yep.
And then you end up looking at those and then realizing, oh, some of these things I thought were risky are not as risky. And some of these things that I thought were safe are a lot closer to risky than I thought they were.
Yep.
Whatever that risky is in your head.
Yep. The crisis in Europe is affecting gas prices. That affects everybody. For one, I think that's the most important focal point right now that you're going to hear about is the gas prices. The stock market, just in general, is going to be reflected in that. So, what's happening before this even happened, we had about a 7% inflation year over year, which is extremely high historically, but it happens. Again, not uncommon. We've had low inflation, low interest rates, blah, blah, blah for the last 10 years. So, us with any kind of knowledge in the financial industry know that that's going to happen. You're going to have inflation, you're going to have prices go up, things like that. So the Fed then says, well, we're going to raise interest rates a quarter point. Then they come back and say, well, now we're going to raise them 0.5%, which is double by March or April, they said. And I don't think this is going to prevent that or stop that at all. If anything, it's going to make inflation worse, which is going to make them want to raise interest rates even more, I think.
Yeah, we'll have to see. I mean, the popular consensus is that now that there's war, they won't do the half percentage rate increase.
Yeah. Well, I don't think they're related or should be related at all. I mean, it's going to be,
I think people are like basically when they increase rates, they expect risk on assets to go down a
right,
little bit. And
right.
they're going to do it slowly over time. And that's why they forecast it ahead of time. So you're kind of ready for it.
Yep.
And then, but when like war happens, they go down anyways. Well, they don't want to do anything that makes them go down in the short term. So they're going to just basically be like, oh yeah, we were gonna do a 0.5%, and that's really important, but we're gonna it's fine. It's fine to delay that another 3 to 6 months. They're gonna probably, I mean, that's not a full-on prediction. It's just that's my understanding of how they discuss these things, which
I think you're
still
probably
makes
right. They like to play it safe.
no sense. I think it makes no sense. If you need to curb inflation, you need to curb inflation.
Yep.
And the longer you wait, the worse it gets, as far
Yep.
as I understand it. So, and Ray Dalio has been saying that for like pretty much forever, since like the 80s. So
Yep. I'm inclined to agree with you.
that's a lot of time for a build up for a bubble. It is definitely kind of freaky, but it's sort of like a game of musical chairs, right?
Mm-hmm.
So, and if you don't play the game, you don't get to retire, basically.
Yeah, really. I mean, yeah,
So,
what's your alternative?
alternative. So you play the game with everybody else. You both succeed with everybody while you're succeeding, and you get screwed along with everybody. But it's better to, I don't know, it's pick your poison almost. But
Yeah, totally.
nobody ever got poor taking a profit. That's another thing people like to say. So selling here and there is not all bad.
Nope. I don't think so either. Or as you get closer to the end of the year, taking some of you high income earners, looking at your losses and trying to harvest some losses.
Yep, that's a nice thing.
Something to think through as well. But that's all we really want to do today was touch base on current events. The market is where it is. We're not going to be able to predict where it's going to be, other than everything might take a hit, frankly. And hopefully, the only thing you take away from today is that understanding that this is a part of history, a part of the predictive cycles. When we look at the potential growth of a particular retirement plan, This is what gets factored into something like a Monte Carlo simulation. It's simulating 1,000 different possible scenarios in the world and the economy and how they could affect your personal goals. And that's what you got to keep in mind, that it doesn't necessarily change things just because you see things are changing. These should be factored into your retirement goals and plans. So keep up with the plan with the perseverance. If you need to change something, or you think you might, or you just want to talk to your financial planner, do so. If you don't have one or you want to talk to us, you know how to get a hold of us. Check us out at financialmd.com. Find us on TikTok and Instagram at FinancialMD. We'll be putting out our weekly videos. And another plug to check out the Financial MD app. We're tweaking it and updating it, making it better all the time. And that's all I got. Trevor, anything else?
That's it. And you're available at Jay Salitro
Jay
at
Salitro at
FinancialMD.
financialmd.com, and you are T Smith at financialmd.com.
That's right. Hit us
We're
up on
both,
email.
yeah, we're both here for questions. So we're not a big a deal as it seems like on the podcast. So you can email us and we'll get back to you.
Yeah, absolutely. We love that.
All right, man. You guys have a great week. We'll see you soon.
Later.